Everyone tells you the stock market always goes up, that if you just stay invested, time will solve everything. That volatility is noise, that crashes are opportunities. But here's the uncomfortable question almost no one asks. If markets always reward patience, why do so many long-term investors still lose money? Why do entire generations buy at the wrong time, sell at the worst moment, and repeat the same mistakes again and again despite having more data, more tools, and more experts than ever before? Tonight, we're not talking about stock tips. We're uncovering the patterns behind market trends, the forces that shape booms and busts, and the strategies that survive when confidence collapses. Because the real secret of investing isn't predicting the future. It's understanding why the same story keeps repeating. Setting the stage, how the market really works. To understand modern market trends, we need to rewind. The stock market wasn't created to make you rich. It was created to raise capital. In the early 1600s, the first stock exchange allowed merchants to pool money for risky overseas trade. Investors shared profits but also losses. Risk was visible. Failure was expected. Fast forward to the 20th century, and the market changed character. Stocks became symbols of national growth. Indexes became economic scoreboards. Retirement systems tied everyday lives to market performance. And with that shift came a dangerous illusion that markets reflect reality. In truth, markets reflect expectations, not facts. Prices move not on what is, but on what investors believe will happen next, and belief, as history shows, is fragile. This is where trends are born and where strategies either succeed or fail. Origins, how market trends begin. Every major market trend starts the same way. Quietly, a new technology, a policy change, cheap money, rising optimism. In the early stages, fundamentals improve. Profits rise, growth feels justified. But then something subtle happens. Prices begin rising faster than reality. Investors don't buy because value is obvious. They buy because prices are already rising. This creates the first dangerous loop. Rising prices attract attention. Attention attracts money. Money pushes prices higher, and suddenly, the trend isn't driven by earnings or cash flow but momentum. At this stage, smart investors are cautious. Most people aren't even paying attention yet. That's how every boom starts. As trends mature, narratives take over. This time is different. Old rules no longer apply. Valuations don't matter anymore. In the 1990s, it was the internet. In the 2000s, it was housing. In the 2010s, it was ultra-low interest rates and passive investing. Each era believed it had solved risk. During the rise, leverage increases, risk is ignored, investing becomes entertainment. People stop asking what could go wrong and start asking how much more can I make. This is when investing strategies shift from discipline to hope. Buy and hold becomes buy and forget. Diversification becomes concentration. Risk management becomes pessimism. And the most dangerous idea spreads. You can't lose if you don't sell. History is about to prove otherwise. The breaking point when reality interrupts the story. No market crashes because of one event. Crashes happen when pressure meets fragility. Rising interest rates. Earnings disappointments. Liquidity dries up. Confidence cracks. The breaking point isn't loud at first. Markets dip. Analysts say it's healthy. Investors are told to buy the dip. But beneath the surface, something has changed. Forced selling begins. Margin calls appear. Liquidity vanishes. Prices fall not because everyone changed their mind, but because someone has to sell. And when selling feeds more selling, trends reverse violently. This is where strategies are exposed. Those who relied on optimism panic. Those who relied on leverage are wiped out. Those who relied on timing realize timing works both ways. The fallout, who really pays the price after the crash, the damage becomes clear, portfolios shrink. Retirement timelines extend. Confidence evaporates. But the most painful loss isn't financial, it's psychological. Investors swear never to trust markets again. They sell near the bottom. They sit out the recovery. And just like that, wealth transfers from the emotional to the patient. Here's the irony. The people who avoided risk entirely lose to inflation. The people who chased returns lose to volatility. Only those with strategies survive both. Why most investing advice falls apart after every crash. The same advice resurfaces. Just stay invested. Dollar cost average forever. Time in the market beats timing the market. These statements are not wrong, but they are incomplete. They assume Stable income, long-time horizons, emotional discipline, no forced selling. Most investors have none of these during crises. Strategies fail when they ignore human behavior. Markets don't collapse because people are stupid. They collapse because people are human. Fear beats logic. Losses feel worse than gains. Crowds move faster than fundamentals. Any strategy that ignores this reality is fragile. Modern parallels, the pattern repeats again. Look at today's markets. Record debt levels. Concentrated gains in a few stocks. Passive investing dominating price discovery. Retail investors entering at peaks. Sound familiar? History doesn't repeat, but it rhymes. Shocking data shows this pattern clearly. A small percentage of stocks drive most long-term returns. Most investors underperform the market. The biggest losses happen during emotional decisions. The tools have changed. The psychology hasn't. Which brings us to the real question. How do you invest without becoming part of the cycle? 3 clear takeaways. What actually works? Takeaway 1. Trends are signals, not guarantees. Follow trends, but never worship them. When everyone agrees, risk is highest. Takeaway 2. Strategy beats prediction. You don't need to know what happens next. You need a plan for when you're wrong. Takeaway 3. Survival is the real goal. The first rule of investing isn't maximizing returns, it's staying in the game. Final warning. The question nitrogen monoxide 1 can answer. The market will rise again. It will fall again. Confidence will return and disappear. The only unknown is when, and that uncertainty is exactly why strategy matters more than optimism. Because the market doesn't reward intelligence. It rewards discipline. Call to action your move. If you want more deep story-driven breakdowns of markets, money, and investing psychology, subscribe to the channel. If this video made you question something you believe, like the video. And comment below, do you think the next big market shift will come from fear or false confidence? Because history is already writing the answer.